It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Hi, thank you. Thank me for that intro. Did I say I was on the intro, Professor Plum? Was that my voice? I believe it was. I said it was. Intro. Well, you know, they don't play that for us. They add that later. It's what they
edit
do.
That in post.
We put that in post. That's right. We'll take that. We'll edit that out in post, is what they say, and they never do. Anyway, welcome back to the program. Cranking along here in season 7. We got a lot of good topics still to come. We've talked so far about Roth or traditional IRAs. Hope you heard that one. We talked about investing in your 401k or your retirement plan, whatever you have. Last week, great discussion on pensions and lump sums versus annuities. We got some emails on that. I should do I know I've said this many times, but we should take a show and just maybe answer emails. Is that interesting? I guess it
depends on the email.
Well, I mean, we don't pick out the good ones and the ones that are relevant to situations.
The more people, rather than a specific.
Broader topics. I mean, we do get emails all the time, and people asking us about their specific situation. But oftentimes we don't have all the information that we need on these emails, and other times
it's very specific.
It's very,
and hardly anybody else will be, unfortunately or fortunately, faced with that situation.
Right, but we have had folks ask us, hey, you know, do you ever read some of these emails? So let me think about that. Maybe
we read them. We just don't read them on the air.
We don't read them on the air, but maybe we should. You know, because we used to do that on our radio shows all the time. And we would have an email segment or two. But anyway, that's just something we might consider. One thing that's on a lot of people's minds, whether it's tax season or not, is the aspect of saving money on taxes. Everybody seems to be concerned about taxes. But Professor Plum, correct me if I'm wrong, very few people really know about their own tax situation. Would you agree with that?
And they're only concerned about the taxes when they file their tax return.
Yes, in April or whenever they happen to file.
By that time, there's very little they can do, if anything, other than if they can afford, do a traditional IRA deductible one. There's very little you can do at tax time to change the tax bill that you have for the previous year.
Yeah, because most of that ended on December 31st.
But they don't take that disappointment, anger, whatever you want to call it, with their tax bill from the previous year that they're filing for now, and do anything about affecting the new year's tax bill. And they don't do anything. They get mad at last year's tax bill that they're filing for today, but they don't say, well, then let me look at this year and see how do I affect this year's tax bill so I'm not in the same grumpy situation when I file my tax return next year.
Now, that if for you folks listening to this particular podcast, you're obviously probably more in tune with your own finances than other people aren't. So we may not be talking about you folks listening necessarily. People who listen to financial podcasts, especially ours, I think tend to be a little more financial savvy. But
I would say yes and no. Let me ask you a question.
Me personally,
You personally. You don't have to answer the dollar amount, but do you know what your federal tax bill was last year?
Okay, I do know what my federal tax bill was last year.
Oh, wow.
But only because I did look at it about 4 days ago.
Yeah. Now, I'm not talking about the refund or what you paid in April.
No,
I'm talking about what you actually owed.
Yes, because
the line that says this is your total tax.
Yes, and because I looked at my actual tax form for a different reason, and I pointed out, I said, look what we paid. But that's it. Now, what the exact number is, it escapes me, but I'm pretty close. Yeah. But if you ask me, no, under normal circumstances, I honestly couldn't tell you. I could get within $5-6 grand, maybe, maybe, if I had to think about it. But no, I don't. Do you?
I actually,
well, you're Professor Plum.
Last year was an anomaly for me. I had a little bit of an issue with it. So I had a deduction that I wasn't expecting. And so it is a different number. So it kind of stuck in my head.
Yeah.
So but no, I usually know within $500 if you ask me a year. Now, if you ask me what I owed in 1989, I'm not going to know that number, but I know what last numbers is. But I also set my withholding up. I know you've heard me say this. I am weird about taxes. I do projections of my taxes And because I don't want to over withhold. I also don't want to under withhold. So I look at what my income is, and fairly stable income. I can get a pretty good idea of what my income tax is going to be, and I set my withholding up to be just a little bit with more than what I expect my tax bill to be, so that I don't have to write them a check. As I have had times where I didn't do this, or I received some income I wasn't expecting, and I had to write a big check.
Yeah.
And that sucks.
Well, people.
I'm glad to get the income. I just didn't like writing that check.
Well, you brought up the point here a minute ago, which was that people don't think about it during the year until maybe April, when most of them are filing their taxes.
But that's for the previous year.
But that's from the previous year, and they say, "Oh man, a lot of times they think." Oh, well, there are a couple things. They think, man, I'm way overpaying in taxes, or, hey, I didn't pay any taxes at all. Look, I got a refund.
Right. Unfortunately, I've heard that answer. So how much did you owe in taxes last year? Well, I didn't owe anything. I got a refund. Well, you got a refund of some of the money that you prepaid. Your withholding and or quarterly payments are basically a prepayment being applied towards the taxes that you are probably going to owe. Or it's a guess on a prepayment of the taxes, so that you don't have to write a big check in April, because two things happen there. Either you're probably not going to have the money because you spent everything that came in during the months, and you're going to know exactly how much you owed in taxes and get pissed off or ticked off, or however you want to say it.
I get it. What line is it, by the way? Do you
now
recall?
I'd have to go back with this new.
The new form.
The new form threw me off, but I could go look it up.
It was 30 something.
Well, it used to be, but it's way higher than that now.
Oh, is it?
Yeah, it's way higher.
Okay.
But
well, anyway, you'll find where you can look on your tax form. It says this is your total tax.
Yeah. Yeah, and so it's there. I mean, I'm sorry, I don't know the number off the top of my head. I had it memorized for many, many years with the old tax reform.
Yeah, but
when they
changed.
changed it a couple of years, I don't like this new tax form. And that's.
Did you like the old tax form?
I liked the way it was laid out.
Ah, okay.
It flowed with a certain amount of logic. I know logic and taxes don't go together.
Yeah.
But there's a tax logic. It made sense to me, maybe because that's what I grew up using since 1986.
Yeah.
And so it made sense to me. This new one is a lot more. There's not as much on the 1040, and you got to go to all these schedules to find out the real answer. So it's harder to do any detective work to help people, but it's there. I mean,
and it's one of the things by design is that people don't necessarily know right away how much they're paying in taxes.
Well, it's also designed for the lower income to basically be as simple. Basically, if you have pension, Social Security, or interest, or a salary, and no investment income, no business income, no capital gains, nothing else going on, it's a very simplistic form. But if you've got anything outside of just the basic incomes, you have all these schedules, and it becomes
much more complicated.
So it's designed for the very low, or the very simple return.
Yeah, which is fine. So the topic really is talking about, I was going to say keeping your tax bill low both now and in retirement. But honestly, Professor Plum, when I talk about keeping your tax bill low, I don't want to give the impression that your taxes should be as low as possible
this year, at the detriment of maybe the future years.
Yeah, and so we should probably call this managing your taxes.
Right.
And we've said this before, it's more important to manage your taxes than to try to
minimize it to zero this year, because you may be hurting yourself in the future.
Yeah, so you're looking long term as opposed to short term, which is I think important to do.
Right. Now, managing your taxes involves some of the things we've already been talking about. The first thing is knowing where you are on the tax return. What is your current tax bracket? What do you actually pay in taxes? And then finding out where you are, because you can't manage for tomorrow and beyond if you don't know where you're starting from. So we have to find out where we are today. What bracket are you in, and things of that nature. And then we have to make a projection looking forward. Okay, what's it going to look like potentially in the future? Do we want to reduce our taxes today because we're going to be in a lower bracket in retirement? Or are we looking at a position where once my pension kicks in, or once a big pension kicks in, Social Security kicks in, and required minimum distributions, we're going to have a much higher income. We won't have any deductions. The house will be paid off. Kids are gone. What is our tax bill going to look like in the future? Is it going to be higher? Well, maybe we want to do Roth conversions or do something to accelerate income pay a little bit today in a bracket that may be lower than in the future.
Isn't it funny
But
how
it starts with, where am I today?
Isn't it funny how all the things that we're talking about now have dovetailed into each one of our topics so far?
Very similar.
This season, it's really interesting. How does somebody figure out what bracket they're in? I mean, you look at how you say, well, how much money do you make? What's your income during the course of the year? Well, you say, well, what is it? My total income? Is it after my FICA and Medicare? Is it, before my
well, that's
health
a common
insurance?
thing too, because I've had people say, well, I'm in the 22% bracket. My salary is $100,000, and I went online and I found a 2021 tax guide.
Your gross,
my income is $100,000, and I went online and I looked at the tax brackets, and it says for a married couple, the top of the 12% bracket is $86,000 and change. Well, I'm at $100,000, so I'm in obviously over that. And the next bracket is the 22% bracket, so I'm in the 22% bracket. Well, the reality is, no, you're not, because you're comparing two numbers that are not the same. My total income of my salary is $100,000.
That's because I make
I make $83.33 a month.
Yeah,
but that's not what goes on the return necessarily. Are you paying something for health insurance? That comes off the top. Are you putting money in your 401k? That comes off the number. So maybe I'm paying, a couple $1,000 I'm paying $4,000 a year for my health insurance for the family. It's being subsidized. So now I'm down to 96. I'm putting $26,000 in my 401k. Now I'm down to $70,000. That's the W-2 income that shows up on the return. But now I've got my standard deduction, call it $25,000. That brings me down to $51,000. So my taxable income, that's what the tax code and the tax brackets are talking about. My taxable income is only $50,000
when I'm making $100,000.
But I've got $36,000 of room in the 12% bracket, and the person thought they were already in the 22. So they said, well, I don't want to do conversions to 22, but you're not at the 22. So the first thing is to understand what we're looking at. There's gross income, there's adjusted gross income, and there's taxable income. The tax brackets are based on taxable income.
So if somebody wanted to figure out what bracket they're in, or at least what they were last year, where do they go?
Well, they start with, what is my gross income? Did I make any deductible
Yeah, all the
things?
stuff that you just said.
Yeah,
so is it? But I mean, can they go to their tax form? Can they?
If their incomes are similar from year to year to year to year, they can go to their tax form from last year and look for the line that says taxable income. What is my taxable income?
So you go. That will tell you what your tax bracket is.
And it's down the way a little bit.
So find where it says taxable income, and then you can go online and find your brackets, and that will tell you.
Right. Now, when you look at taxable income, the other thing you need to know is, did I have any long-term capital gains? Did I have any capital gains at all first? But if I had long-term capital gains, that's part of your taxable income, but it's a different bracket. And so it's a little bit, my taxable income may be $90,000, but I had a $30,000 capital gain. Well, what is my true tax bracket? Well, for ordinary income, I'm in the 12% bracket. But if I have any more capital gains for that year, I'm actually in a 15% bracket. So capital gains makes it more complicated. But generally, you can look at that taxable income number, and if you don't have any capital gains, then you can go to the tax tables and find out what bracket you're in.
Yes. Now, something else that people get confused about that we've brought up in the past, somebody looks at their taxable taxable income, and they go to it and they say, okay, well, based on my taxable income that Professor Plum mentioned on the podcast, I'm looking at it and I'm in the 22% bracket. So that means that
22% of that whole number?
My entire so at $100,000 of taxable income, I
owe $22,000
in taxes.
Well, thankfully, we don't have a regressive tax code quite like that. When we're looking at the tax code, if we go to the taxable income line, that's after all the deductions and that we can take, and now we compare it to the rest. For a married couple filing a joint return, there's about the first $20,000, 19 and change, is in a 10% bracket. And then from there to the $86,000 number is in the 12% bracket. Above that is in the 22 to a certain level, 24 and up the line.
Yeah.
We don't have a point where when we cross over the next bracket, that it becomes regressive and says, well, now every dollar is taxed at this new bracket. You still get, and you just basically add up the tax on each of those different categories.
It adds up, and it averages out.
But it
to
would
something
probably
less.
be half of what that.
Yeah.
So in that expense, you have $100,000 taxable income. It's not a 22,000. You're in the 22% tax bracket, but you don't owe $22,000 in taxes. You probably owe 11, maybe 12,000, which still stinks. But
it's a blend of a 10%.
It's a blend of a 10, a 12, and then a little bit of the 22.
Of the 22. Yeah. Yeah.
So,
and I think that's important to understand.
Yeah.
Let's talk for a second now that people understand. One of the first things you said was we need to know
where we are.
Know where we are in managing your taxes, whether it's keeping them low over the long term, which is the goal of managing taxes, or not. What's the next step in managing your taxes once you figure out where you are in the tax bracket?
Well, you've got to understand where you are, but then where are you going to be in the future? Do I want to reduce my taxes today at the detriment of tomorrow? Or do I want to increase my taxes today at the benefit of tomorrow? Or it's all about, okay, where am I at? Where am I going to be? What's going to make the most sense in both situations? So what do I want to do? Now, a lot of people will be in a lower bracket when they retire. So I had this discussion with somebody the other day. They're making a little over $300,000, and they're saying, when I retire in 5 years, I'd like to have some Roth money. And I go, so what's more valuable to you right now? That tax deduction. You put $10,000 into your 401k, you're saving $2,400. He also lives in a state with a high income tax, so you're basically saving $3,000, a little over $3,000, $3,400. And I go, in retirement, your income's going to be 100, 105, 110 is what we're looking at. So when you take the money out of the 401k at that time, you're going to owe $1,500 in taxes, federal, state. Do you want to give that up to have a Roth IRA, or to have a Roth to reduce your contribution to the traditional 401k and increase the Roth side of it? He's like, no. But he's like, I really want, and it makes sense for some people, but when you put it down to dollars and cents, do you want to save $3,400 today and pay $1,500 later on the same $10,000, or do you which makes more sense to you? Now, sometimes they say, it would really be nice, and sometimes it does make sense to do.
So you're saying sometimes it makes sense to pay taxes on certain money today,
right,
rather than defer.
Well, in that
them.
case, it didn't. In that case, it made sense. But if somebody was, in the same bracket, their income was $100,000 today, and it's going to be $100,000 in retirement or close to it, where it's kind of a push, and it's like, okay, I can save some money today, or I can pay later. I can pay it today and have. I like having flexibility. So if it's in that same situation kind of area, I like that Roth idea of building up some tax-free, but it's all a matter of if you know where you're at today and what you're saving, costing, whatever with the issue, and what you expect to be at the future when that money's going to come in or out, or what we can do, you can make the decision on which makes more sense to you, which feels better. But if you have no idea, I've had people say, I got to do something about my taxes. And we show them their tax bill. We go back to their tax return, and they were paying quarterlies and doing some other things, but their taxes were like an average of 3 or 4%. And it's like, unfortunately, you don't like the taxes you're paying, but as a percentage, it's not very much. Unfortunately, people don't like to hear that, but they just weren't even aware of how much income did I have? Well, between your pension, your social, this, that, and the other thing, you had X amount, and you paid about 3% of it in taxes. Like, I had that much income? All I saw was the tax bill, and I didn't like it.
Well, this comes down again to knowing where you are.
Exactly.
And that's why the first thing you said, I guess, Professor Plum, was know where you are. Know what your taxable income is, and that will tell you where you are in the bracket.
Right. And, the hard part for some people that are people that don't have fairly stable incomes. They have a big income one year, low income the next year.
Yeah.
And they don't even know what their income is, really until they ferret out the expenses and everything for their business and such. And sometimes it's after the end of the year. Hopefully they're doing some projections so that in November, December, they get an idea.
Yeah. So
that they can, do some planning on how much should they put into their retirement plan this year. How much? Maybe this year they don't need to put it in or want to. They should put it into a personal account or some other form. Do they need the deduction of the traditional side or the
what does
the
it
Roth
mean?
side?
What does it mean for the average person to manage their taxes? I mean, you have somebody who's in their 50s or their 60s. and they've got a fairly stable income. It doesn't change much year to year.
A lot of it has to do with whether we're going to be doing traditional contributions or Roth contributions. Where do we show the tax? Do we show it now, or do we show it in retirement? Now, the problem with retirement, people look at it and say, well, in retirement, I'm going to be, I'm making $100,000 now. In retirement, I'm going to be making $70,000 between social and, so I'm going to be, lower bracket in retirement. But the physical bill may still stink in the fact that I'm taking $30,000 out of my IRA and I'm getting $40,000 from my Social Security. But if I could take some money, it's effective. So really what's happening, I'm in the 12% bracket on those monies I'm taking out of the IRA on the last monies, so I'm taking 30 out, but if I could make it 20, that extra 10, if I could take 10 from a Roth and 20 from an IRA, that would drop my tax bill, not by 12%, but by 20%. That doesn't make any sense, Rick. I'm in the 12% bracket. Yeah, but for that last $10,000 you took out of the IRA, 401k, you paid tax on every one of those dollars, plus 85 cents of each of your Social Security dollars.
Yeah.
So you're actually paying tax on $1.85 for every dollar you take out. That's a little over 20%. And so I'm in a higher effective bracket when I take the darn money out than I am today. If I put it in at 12%, it's costing me 20 when I take it out later. So maybe some of that money should be going to Roth and build up that flexibility so you have to maybe keep your Social Security out of the taxable
So what you're saying
environment.
is, in that example, some people are better off paying a little bit more of the taxes today.
Right. Even though their income is higher today than it's going to be in retirement, it makes more efficient use of the money to use that 12% bracket and build up Roth. And then even though you're in 12% bracket in retirement, you think you're not effectively because of that darn Social Security taxability that phase in. I mean, it's not a cliff. It's not like you go over a certain number and then boom, 50% of your social,
but
boom,
some
85%.
of it is
And then
gradually.
and so we have that ability to phase it in and out.
This can go back to our discussion too on the Roth versus traditional, which is one of the things that you talked about a few weeks ago. But when you're talking about managing your taxes here, it's not so much necessarily what you're paying today. It's more about maybe what you're paying
today, tomorrow,
over,
next, the following year, for the rest of your life. And also, in some cases, what, as a retiree, we're planning for a joint life, but most likely there will be a survivor at some point with that married couple that may live for many years after that. And the survivor, we got to look at their tax brackets too. Where are we at today with both of us? Where will we be some point in the future with only one of us? We're going to lose some income if we both have Social Security because one of the Social Securities goes away. And the tax brackets are they're the same bracket, the same number, 10, 12, 22, and on so on. But the amount of money you can have in each bracket, I was talking about having $100,000 and staying in the 12% income tax bracket. That's a married couple. You can't have that much money, that much income, and stay in the 12% bracket as a single taxpayer.
No, the
It'd be
brackets
about
changed.
half.
The brackets changed.
So it's still 10 and 12, but instead of the 12% ending at 86,000, it ends at like 43,000.
Well, now what about the average person probably has a lot of pre-tax money socked away by the time they retire. You take a married couple, maybe they've been building up their 401ks over many years.
Very common.
That's all tax deferred money. Maybe they've got an IRA, that they've been building, maybe some Roth, but a good chunk of their money is in these pre-tax accounts like 401k, 403b.
Because they couldn't spend it.
Because they couldn't spend it, and that's how they saved.
Yeah.
And it was a great vehicle because they got...
It was easy. It was automatic.
They got a match. They got, all this stuff which really helped them. And so what they find is by the time they reach retirement at age 65 or whatever, that they've got a lot of this pre-tax money sitting in these accounts. Now, it may not be a bad thing, but, they're looking at required minimum distributions coming up in 7 or 8 years whenever they retire at age 72. I mean, there's some planning that should go on there too, right?
Well, what is the first thing we look at when we're dealing with a retirement situation? The first thing we're going to deal with is, when do you take your Social Security? And sometimes it makes sense to defer it if you think you're going to live a while. While you're deferring it, we don't have to worry about the taxability of the benefit because you're not receiving a benefit.
Yeah.
Now we have true tax brackets, and we might want to be doing conversions to reduce that tax-deferred number into tax-free.
You mean converting some of that 401k money
to Roth?
To a Roth, some of that tax-deferred money.
Or if I've been lucky enough to save 401k and personal money under a Roth money, some people will go into retirement and they'll spend all their personal money. If you go online, what's the best tax way to spend your money? Spend your personal money first.
This is what they say.
This is what I read online all the time. Spend your personal money first. Take your required minimum distributions at 72 and don't touch your Roth. That's for survivor, which I tend to lean towards anyway. But spending your personal money first could be completely tax stupid, because if I'm spending my personal money, I'm not creating any taxable distributions. I'm only earning some interest on the accounts. So I probably have a zero tax bracket. And maybe I'm deferring my Social Security, maybe not, but I'm not paying any taxes for a little while. But I'm also not touching my IRA. So what's happening with the IRA? It's growing. So by the time I get out to 72, that required minimum distribution, and maybe I started taking my Social Security at 70, now I got a tax bill for the rest of my life. Rather than that, why not spend when we have a 0% tax bracket, when I have a very low tax bracket? Instead of spending personal money, let me take the money out of the IRA. I know I've got some room in those lower brackets in that case.
And you got to pay taxes on them at some point on the withdrawals.
So let me spend the IRA while it's tax beneficial to me. I can pay 10%, even 12% on it instead of 22, 24, a couple years down the line. So spending personal money before spending IRA money is a dumb idea. I mean, it's just...
In every case?
I'm trying to think while I'm talking here.
I don't usually hear sweeping statements from you like that.
Let's say, even if I take my Social Security at $40,000, $50,000 a year between a husband and wife, $30,000, we know what the number is. Unless you've got two people that continued working until 70 and have max Social Security, and they're getting $80,000 from Social Security, but the average person, I'm trying to think of what's the average social between the husband and wife or two spouses? 40-ish, maybe? I don't know.
I don't know. At
that level, yeah, I should be taking some money out of my IRA. Unless I've got a huge personal account that's throwing off, $50,000 in interest and capital gains, another $20,000, and I got dividends of another $30,000.
In other words, unless you're in a high tax bracket.
Unless you're already paying a boatload of taxes, but the average person's not. Going back to the person you talked about, if you got mostly IRA, maybe a little personal money on the side, they should be taking some. I'm not saying they may not take the entire amount that they need, but they should be taking some money out of their IRA.
But that means paying taxes now.
Not necessarily.
Right.
Because I have this stupid Social Security taxability scaling in system where, if I've got, like I said, $40,000 of social and I need $80,000 a year. I'm making numbers up. Sounds good, though. Sounds reasonable.
Yeah. Okay.
So where should I get that other 40? Now, if I take it all from the IRA, now I'm going to pay some taxes on my Social Security. If I take it all from personal money, I'm going to pay nothing in taxes. But if I take some money, until the required minimum distribution kicks in, but if I take some money out of I take $10,000 out of my IRA, how much in taxes am I going to pay on that $10,000? Nothing. Because at that level, I haven't started the taxability of Social Security left because of the way it works. And at that level, my standard deduction wipes out the tax on the 10 plus whatever interest I've earned. So there's some room. So I just took money out of the IRA tax-free.
Why would you ever not want to do that?
The question is, how much room do I have
to
be able to do that? And for the average person, there's average retiree that is spending personal money only and living on their Social Security, there's some room to take some money out in a very low, if not zero tax bracket from their IRAs. You got the deduction going in. If you can get it out.
Can you imagine that it was deducted at the 22 or 24 bracket.
Or back in the day, 28.
Or 28, whatever it was, and you take it out tax-free? I mean.
Now, it may not be enough to make a huge difference in the future, but I like tax-free.
Why is there, you said there's a lot of conventional, you go online and they suggest you do the opposite.
I don't know why they're thinking that way. I wish I did.
Why is that? Yeah.
I don't know why they're thinking that way. Either they don't understand the
these
tax
are normally
code.
These are normally journalists who don't necessarily understand the way certain people who have studied been in the
I've mentioned
industry.
it before. I was, years back, it's been a decade or more now, I was speaking in front of some tax preparers. I was talking about financial planning, and there was 35-ish.
Are these CPAs?
Well, these were people who considered themselves and made their living as tax preparers. There was only 2 CPAs.
Oh, like an enrolled agent or something?
There weren't that many enrolled agents. I mean, there were a lot of, some of these bigger companies that just do taxes.
Okay,
I'm
so
not gonna
tax
name any
preparers.
names. They were tax preparers, people that you would go to do your taxes. They're not necessarily CPAs or EAs, enrolled agents.
Okay.
There were a couple of CPAs, there were a couple of EAs in the room, and I asked the question. I said, how many of you are comfortable explaining how to calculate the taxation of Social Security? 2 people raised their hands. And when I talked to them later, they didn't know.
They lied.
I mean, it's a certain formula that works and things. So most tax preparers work very well. They get the forms, they input the forms into the computer, and the computer does the work. But how putting this income in this piece here affects this income over here, they don't know. And so understanding that interrelationship between other income and the Social Security is important in trying to manage your tax bills. And so you need to find somebody who knows those issues if you want to do any kind of. Now, I'm not saying it's going to work every time either, because I've had a discussion on taxes with a couple individuals over the last month or so, and they weren't going to be able to do anything. Mostly because they had a $3 million IRA, and there just wasn't enough time and or room to affect anything that much. They had pensions, they had good Social Security, and they had a ton of, and they had personal money. And
hey, okay, you know what? Put me in that situation, okay? It's like going in estate tax.
And they were worried about the required minimum distribution coming up.
Yeah,
and they were wondering, in my opinion, which I have no idea what Congress is actually going to do, whether Congress would get rid of the RMD. There's been some rumblings about that.
Yeah.
And from a political standpoint, I just don't know how they could, because the only people that will be affected positively by getting rid of the RMD are people that have a lot of money.
Oh, sure, because everybody else,
we're living on the money.
Well, they're taking more. They're taking
more than our RMD because we got to live.
Right.
But so the only people. But they may make it sound, they could spin it any way they want. But it's a matter of sometimes paying taxes isn't the worst thing in life. It just means you have a lot of income, and you just have to grin and bear it. Unfortunately, the good news is you got a ton of income. The bad news is you got to pay a bunch of taxes, but you're still going to have more income than you ever needed.
Sure. And the other side of it was that you mentioned too, sometimes you pay taxes now to avoid paying them
right. And that's
later on.
Most of those questions are, can I do Roth conversions large enough to make a difference in the future?
It takes knowledge of tax brackets, and it takes knowledge of how to calculate these things. And I don't know many people that can do this kind of stuff on their own. It helps to have somebody looking at these numbers for you. I think you would agree.
It's somebody who understands how they work.
Yes. And it's sort of if you do this, here's what happens as a result.
Right.
And run these numbers, and then you can make your own informed decisions. And that's what you do when you hire a financial advisor. You can talk to somebody like Professor Rick Plum, any of the Lucia Capital Group advisors. We talk about taxes. Taxes, Professor, it's one of those things that has to come up in a discussion of a financial plan.
Always.
And the amount that you can save in taxes, maybe not in the short run, but over the long term, can make a big difference to your overall strategy.
Well, taxes have an impact on the strategy, because somebody may come in and say, okay, I'm going to retire and I need $6,000 a month. Okay, you need $6,000 to spend, but how much do we need for taxes? We have to be able to then look at where the money's coming from to say how much over and above that do we need to be able to provide to pay the taxes as well, so you can have your 6 or whatever number it is you want to spend. Because the portfolio, the incomes that come out of their Social Security, their pensions, and their portfolio have to meet that higher number.
Exactly.
So maybe their social is 2 and they got a pension of 2, so they're saying I need 6, I need 2,000 out of my portfolio, but you haven't accounted for taxes yet, and maybe the taxes are 1,000. I'm just making it up. So we really need to take 3,000 out of the portfolio. That's a different allocation than somebody taking 2,000 out of a portfolio, taking 24,000 versus 36,000 a year. So you have to know these numbers to create the appropriate investment allocation over and above your pensions and Social Security So you got to have the right allocations to supplement those, and you got to have it in the right place. But you got to know the number first.
You got to know the number, and you got to find somebody who enjoys finding that number, like Professor Plum, or
Weird
any
as he is.
Weird as he is. 800-644-1150. Any of the advisors at Lucia Capital Group can help you out with these things. They're all working with Professor Rick Plum. They put the plans together under the watchful eye of Professor Plum. So. It's finding somebody to do this and who understands all this can be difficult. It's what the folks at Lucia Capital Group do every single day. Let me give you their number again, if I haven't yet. 800-644-1150. Talk to Professor or the advisors that work with him. 800-644-1150. You can also go online, LuciaCap, LuciaCap.com. A lot of things you can find on our website there. There's some articles, there are videos, there are calculators, ways you can talk to. Get some help. Get the help you need. If you want to do some of it yourself, they can certainly guide you along that way as well. LuciaCap.com. Find out about our podcast. We talk about these things. We got more great topics coming up here over the next few weeks during Season 7. Subscribe. Go to Spotify. I almost said Spotify, and you can find our podcast there, Managing Your Financial Future, and certainly subscribe, get it downloaded right to your device, and listen to your heart's content to any and all of our many, many episodes. Professor, thank you so much. I know there's more we could have said on this. We're out of time. I would like to cover taxes maybe again, not necessarily next week, but over the next. Yeah. Hey, I got an uncle in taxes.
No, we're talking about dollars,
That's
money.
where he lives. Dollars, taxes. Thank you, Chico Marks, for giving us the closing remark. We really appreciate that. For Professor Rick Plum, Certified Financial Planner Professional, I'm Johnny Dean, your podcast host. Thanks so much for listening, and we will talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and or investment strategies devised by LCG, will either be suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties and, if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.